Thank you guys for joining us this evening for our Chavis Capital webinar. My name is Nathan Johnson. I'm Director of Marketing for Chavis Capital. We've got a great conversation for you guys tonight featuring Dr. Daniel Firth and also Brian Chavis from Chavis Capital. Just getting everything set up right now, so please bear with us as we are letting everyone in. Let me see here. Danny, let's get you unmuted. And Brian, let's get your mic up and running as well. Okay. There you go. Good to go. All right. All right. So I'm going to just jump right on into this. We've got an hour. Danny, how you doing today, man?
I'm doing pretty good. How are you, Nathan?
Hey, doing great. Thank you. Thank you. Let me get my screen up and running here. And once again, thank you guys for joining us this Wednesday evening. I'm used to saying Thursdays. We usually host a educational event every single Thursday night. You guys are always welcome to join us. You can visit buyitrenitprofit.com to learn more about that. But tonight, we're going to introduce you guys to achieving wealth as a multifamily investing as a passive investor. And so Danny just would like to introduce Dr. Daniel Firth. Danny, would love to talk about how did you get involved with Chavis Capital, and would love to hear your story about how you got into multifamily investing. My question, and a lot of people probably think this, as a busy doctor, why are you looking for other wealth opportunities? You know, we usually think the money's flowing, everything's good. Why is this something that you're looking to use as part of your investment portfolio?
Sure, Nathan. I'm happy to talk about that. So I'm Dr. Danny Firth. I am a family medicine doc, and I work full time as a hospitalist. So I've got a little bit of flexibility in my schedule. For those of you that are in the medical field, that means I work in the hospital. So I work 7 days, and then I'm off for 7 days. So I have a little bit more free time. And, you know, I got interested in multifamily 5 years ago as a way to make some passive income. And, you know, I went to some boot camps, learned a little bit, and kind of just slowly started dipping my toe in the water. And then 3 years ago, I heard Brian talk at one of the Tampa Bay real estate meetups. And, you know, I could tell he spoke with authority, you know, and he seemed like somebody that, you know, I could learn from. And so I went and bought his book, Buy It, Rent It, Profit, called him, and you know, we had a conversation, and he asked me what I was interested in, and I kind of told him where I wanted to go. And, you know, he said, why don't you come meet me down at Park Plaza, which is his apartment building down in St. Petersburg, Florida. And so I met him down there, and he put me to work. The first time I was down there, I think we were pulling some weeds the first time, which I thought was a little surprising. But that was my introduction to multifamily with Brian Chavis. And so we talked, and, you know, and then 2 weeks later, my next week off, he said, you know, come down again if you're still interested in learning more. And so this time I came prepared. I had some notes written down. I had a bunch of questions with little check boxes I needed to answer. And so I went down, and the second time, I believe we put down some mulch. But along the way, you know, I asked him a bunch of questions, kind of learned about how he runs his property, you know, why he was making certain decisions. And then as time went on, you know, literally months, he just let me become more and more involved in the property. And, you know, I started mentoring me more. And you know, I got to show some units. If there was a prospective tenant coming by, he gave me the keys to the back end to Buildium to kind of learn, you know, how you reconcile the rents and, you know, make sure there's no delinquencies. So just kind of slowly kind of got more into this. And And then eventually he asked me to become part of Chavis Capital. And so, that's kind of a short version of a long 3+ year history. But, Chavis Capital is obviously started by Brian Chavis. He's the CEO. And then I'm one of the principals. And then there are a handful of other principals that Brian has kind of chosen to be part of this team. And I'll let him kind of, go through who else is involved with the team.
Absolutely. And real quick before Brian jumps in, I've been working with Brian for almost 10 years now, so I kind of assume that everyone already knows who he is. But if you're on this call for the first time, Brian Chavis is the author of the best-selling book, Buy It, Rent It, Profit. This book has been selling over 150 copies a week on Amazon since 2009. You can find this book in Barnes and Noble and all your local bookstores, national bookstores. And he founded the Landlord Academy, which has now become Buy It, Rent It, Profit Education. He's trained over 50,000 landlords and investors nationwide, and currently started Chavis Capital as the CEO and founder. We've been training landlords for I've been with them for nearly 10 years. We've seen so many people achieve wealth that we were sitting there just looking at each other. We've got to start our own fund and our own capital investment firm. But thank you so much for taking the time to speak with us, man. Welcome to the panel. And would love for you to introduce Chavis Capital and the team.
Thanks. First of all, thank you guys for your time this evening. I know getting away on a weekday is not always, it's challenging. It's challenging for all of us, especially myself and Dr. Danny, who have kids. So it's always challenging to lend your time or to invest, some time into a program like this. So I would hope to not only talk about what we're doing, but to also give you some insight. And one of the first pieces of insight is, a lot about Dr. Danny's story. He paraphrased it, but there was weeks where I didn't have conversations with him. He just came and I gave him a shovel and told him to go pull weeds or water plants. The reason why I did that is because, I'm approached all the time with people that, that think multifamily is their next big idea. I've been doing this for almost 20 plus years, over 2 decades, through many cycles. I understand the business. I understand it's not a fad, but, for the most part, especially over the last few years, there's an expert and a guru on every corner. Everyone's interested in multifamily. That's all you hear about now is multifamily. So obviously there's always someone asking, for your time. So, it was my way of weeding through a lot, because there was probably what Dr. Danny didn't tell you, there's probably 15 other people that showed up with him. And there was only maybe 1 or 2 that stayed. So out of 15 people that showed up that wanted my time, and again, time to me is something that's extremely precious. So people want your time. They want to take up your time. It was just my way of figuring out who was really serious. So you make them water some plants, pull some weeds, kind of ignore them a little bit. They come back, then, you further the conversation. Well, Dr. Danny just kept coming back and coming back and coming back. I mean, it was like this was the heat of the summer too. So this was like 90 some odd degrees, 99 degrees. It was hot. And this man just kept coming back. But I knew eventually where I was going. For most of you who know my entire story, I've been gone. The reason I've been gone for several years is because I was diagnosed with a brain tumor. And for, several years, I was, I had to learn how to walk and talk again. So there was a lot that I had to go through. So I was coming back. But while I was coming back, I was figuring where I was going to, how I was going to reinvent what I was going to do, why Landlord Academy eventually came by and Rent It, Profit Education. There was a lot of business decisions that I had to make and reestablish my identity and my brand. So as Dr. Danny started coming back and showing up and bringing this, who in this day and age of tablets and smartphones, who comes And number one, who keeps showing up in 90-degree weather, 100-degree weather, really, and waters plants because they want to know about multifamily, day in, day out. And then who shows up with a notebook pad and a pencil, not an iPad, not a cell phone, but a notebook pad and a pencil, and taking hand documented notes. So after conversations and many conversations, and me kind of then starting to kind of groom him and mentor him as he talks about, I began to see the talent that he had, and Dr. Danny has many talents. And as I was thinking about where I was going to be in the next 3 to 5 years, and the fund that I wanted to start and the team that I wanted to build, because as you have a fund, what I think a lot of folks have gotten away with is really not focusing on really great teams. They focus on great marketing. And that's and it's understandable, because real estate has carried a lot of individuals, and especially a lot of these gurus that you see, that are out here, these talking heads that speak multifamily. It's that none have really been tested through operations. None really understand operations, whether it be asset management or property management. Most have never even leased an apartment or managed an asset a day in their life. And so understanding that is really understanding that, I wanted to understand and really focus on building a strong team, one that would be able to weather, any type of storm, one that I was trained in the multifamily industry to put together. And so, Dr. Danny fit, his character is what I was really after. The understanding how to underwrite and understanding asset management, understanding property management, those are things that can be taught to anybody. But character is something that cannot be taught. Discipline is something that cannot be taught. The will to succeed, the will to get better as an individual, something that cannot be taught. And so those are the things that really struck me about him. And, we can go on down the line from, Shane, who's on a call, another principal, a professional athlete, someone who I, identify really well with. Why? Same thing. A lot of these things can be taught. These guys are not coming from, my industry of multifamily. But see, I can teach them multifamily. I can teach them asset management. I can teach them property management. But discipline, character, the ability to work towards a common goal. These are things that, obviously a professional athlete like Shane, these are things that he knows about. We have, I wanted to find one of the best eviction our corporate attorneys that were out there. So I sought after Melvin, which is the guy, in the picture there with the microphone in his hand, sitting down in the button up. I sought after the guy in the suit next to Dr. Danny in the top photo there, with the beard. He's our landlord tenant eviction attorney. I wanted to have within Chavis Capital in-house landlord tenant eviction attorneys, not subcontract out the work, but I wanted one in-house. As I develop my management plans and as I develop, the operations and procedures for each property, each portfolio, I wanted to have a landlord tenant eviction attorney right alongside me. And you'll kind of, as you understand our method and why we do certain things, we discuss strategy, it'll become clearer why you want to have that in-house. From the guy in the middle there with the glasses, with the blue blazer on, standing up. Chad has done over $1 billion worth of assets, one of the smartest multifamily lenders, a specialist in the Fannie Mae, Freddie Mac space. All he does is multifamily loans, and he was an analyst on Wall Street beforehand. So, his brilliance and what he brings, the analytical mind to the table, it's hard to find, these guys that have not only the talent, but the character. And then Nathan, who puts everything together, the branding, the websites, all of the technical, the podcasts, as Nathan has said, we've been together over a decade, but, his talents, speak for themselves. They're award-winning talents to individuals like Miss Karen Flowers, who's on the call, who's our key assistant, and her husband, who's now our broker for Chavis Capital. Everyone has a unique story. And I'm not going to take, any more time up talking about, going into each story, but everyone here, the one thing I want everyone to understand is everyone is a specialist. Everyone has trained and developed themselves to be the best. But they're also extremely talented in other areas, professional athletes, doctors, lawyers. So you're talking about all high achievers. And you're talking about high achievers who are disciplined and who have character. And to me, outside the multifamily, there's an old Asian proverb that says, I'd rather take 3 lions in the battle versus 300 sheep. These are my 3 lions, and I'll take these guys into battle with me anytime.
Hey, appreciate that. Appreciate that, B. It definitely does feel like family. And, as you guys are listening and joining us throughout these webinar series, you're going to get to meet some of these individuals and as they share their stories and share some of their expertise. So we love to invite you guys back. So Danny, I want to ask you a few questions, man. So why invest in real estate? Passive investing. As a busy doctor, why is passive investing something that you're looking at for yourself?
Sure. So, passive investing, just simply means you're putting up capital and somebody else is doing the work. So, when you're a busy professional, like a lot of us on the call, and, a lot of just accredited investors or professionals in general, time is our most valuable asset. So if I find an investment, with a group of people I can trust, and I can write a check, and every month or every quarter I get a distribution, that's a great deal for me, because I'm not trading my time for money at that point. I can go to work and they pay me pretty well, but it's work. I love what I do, and I would, even if I didn't need the money, I wouldn't quit doing it. But it's still, at the end of the day, it's still work, and you're still trading your time for money. And if you can, if you can put your capital work and, get a reliable passive investment, it's a win. And so, there's a lot of ways to invest. There's almost an infinite number of things nowadays you can invest in. There's crypto, there's startups, there's all kinds of things. And so, Brian and I were talking about this slide earlier, and it didn't even make sense to him. He didn't understand the question. He said, why invest in real estate? He's like, what do you mean? Why would you invest in anything else?
Yeah, tell us about that, Danny. So you've had some experience with some other things like stocks.
Right.
Tell us that story.
So what I would say is, I have not always invested in real estate. I've started investing in real estate 5 years ago now, and I wish I had started a lot sooner. I think it is a valuable part of anyone's portfolio. And, what percentage of your portfolio you put in really, is up to you. I think somewhere in the range of 20% up to like 80%, depending on, what your knowledge is and what you're into. But I think the days of, 60% stocks, 40% bonds, those days are gone, especially in an inflationary environment like we're in. Like, you want something that's going to hold its value and that's also going to make cash flow. And there's not too many other vehicles that do that as reliably and consistently as real estate has, not for like a couple years, or, like Bitcoin's done really good for 10 years, but real estate's done really well for centuries. I looked at this chart that CBRE put up, and it looked at like decades basically.
Right.
And there's like a couple little blips here and there along the way. Like, if you look at, like, when everything crashed in 08, 09, there was a little tiny blip, but it was literally a blip. And as long as you didn't sell during that 2-year window, you were still making cash flow. It's just the value of the property went down. But if you held on, and a couple of years, the value just kept going up and up. So, that's why I like real estate, is it's consistent. It makes cash flow, as opposed to your stocks that just sit there. And it's nice to see the number go up. It's painful to watch it go down, but unless you have really high dividend paying stocks, you're not getting any cash flow. So you can't live off that money. So it's the nest egg theory, that one day I'm going to build up a giant nest egg and I'm going to live off that. As opposed to buying assets that make cash flow that, you can use that money now, or you can reinvest it, whatever you want to do. And then, one other thing that comes up a fair amount is the tax advantages. So, right now, my main job, I'm a W-2 employee, and I pay 25%, somewhere around 25% taxes, which is a big number. But even as a passive investor in real estate, you get the tax advantages. So I'm, not an accountant, and so I'll preface this with that. But basically, you're going to be paying, in general, single digits on your returns from your real estate, as opposed to 25-30% on your ordinary income.
So I want to take a deeper dive into that. So you're saying investing in real estate, and some of the people are listening, but I know. So I go out and buy a single family home, run to my real estate investor association. Why multifamily versus other types of real estate?
Sure. So I think if you want to buy a single family home and you want to run it out yourself, go for it. Go buy Brian's book, Vegas Course. Make sure you know what you're doing. But and there's a role for that, and there's a role for doing both. I mean, I frankly, to be honest, I do both. I have money in syndications, then I have money in individual properties. I think the advantage of a fund or a syndication is that you're a passive investor, and that you are putting up capital, getting a return, and there's no active work. When you own your own property, or if you do it as a joint venture with a couple of your buddies, there's work, there's phone calls. Even if you're going to be the manager, the property manager yourself, even if you're going to hire out a property manager, you still have to manage the property manager. And so you still have to put in some time and be actively involved in that property. And, the advantage is just you just save your time and spend it with your family, spend it on your hobbies, and, let us do the work.
And I'll mention too, as well, Nathan, is that the real beauty in it is benefiting from the economies of scale.
Okay.
So the ultimate end game is to grow the wealth as quickly as possible, as safely as possible. There lies the problem. Typically, when you're talking about investments that throw off a lot of cash, you have to understand that means there's risk associated with that. No difference in the multifamily space, understandably, but there's risk associated with it. And how you mitigate risk is through the economies of scale. And a quick example is I had a single family house and Dr. Danny had a duplex, and I had one vacancy. He had one vacancy. He's 50% vacant. I'm 100% vacant. He shaved 50% off of his risk factor by only one more unit. So you can hide a lot of dead bodies, not in the critical mass, but you can also the velocity of your money. You can also accelerate the process, the wealth building process, through less risk. Number one, especially with going in with others who understand and know how to navigate. And we'll talk a little bit about that when we get to the strategy part. But the key is understanding how to go with others who know how to navigate. But you're going with others in much larger groups to be able to, benefit from the economies of scale, taking down much larger assets. That is the true benefit and advantages that have happened when the Jobs Act was enacted to allow us to have these types of exemptions within the SEC guidelines. What it did was open up a pathway to accelerate your wealth. And that's what you've seen. That's why you've seen an exodus. If you notice, when I wrote my book in 2009, if you have any of the original copies, most of it was talking about, even back in 2009, I put multifamily in there, but there was a large portion that spoke to single family operators, because that was the way to build wealth. 5 greenhouses, 1 red hotel. But then when the Jobs Act came in and those exemptions within the SEC guidelines allowed for going right to the red hotel, it kind of changed the game. And so now everyone jumps right into the red hotel. And that's kind of where we are right now, is, operating these red hotels. And that's why it's kind of difficult to find out what operator is really operating and what operators have benefited from just, a really healthy and robust economy and real estate market, because you can hide a lot of mistakes. I don't know if you remember, we Buy and Rent and Profit Education also has a consultant arm where we're actually an award-winning consulting firm where we consult for a lot of family offices, hedge funds, and public housing authorities. And if you remember in Orlando, Nathan,
Mm-hmm.
and it's on YouTube, so if you want to go and check it out for yourself, I mean, we were on site in Orlando at a project over 500 units, and you would have thought, you know, it was basically run by, it was an embarrassment the way the property was being run, but it was actually still profitable because of the amount of units, all the mistakes these individuals were making, a lack of inventory, overspending in maintenance, maintenance items being stolen out of the shed, et cetera, et cetera. I mean, the list goes on and on. Delinquencies above, 25%. Renewals rates were just, it was an embarrassment to say the least, but yet profitable because of the economies of scale, the amount of units, the size of the portfolio. So, the benefiting, and I'm saying this because, at the end of the day, that is why you see a flight to multifamily as well, is just because the ability to generate wealth while still, making mistakes,
Right.
is, why you see a flight to that. And of course, affordable housing is something that is, that's debatable now with the rents, in some markets going up 24%, whether things are really affordable. And, we can get into that in another webinar, but at the end of the day, there's going to be things that people need, and a roof over their head is one of the major necessities. So, amongst other things, that the economies of scale is one of the most important reasons why individuals invest in multifamily, to accelerate that dollar.
Absolutely. As you guys are listening to this, my experience with this, I hear a lot of people just show me the deal, show me the deal, show me the deal. You should be scrutinizing, the business model of anybody you're looking to invest with. And so, B, I would love for you to break down, the business model and talk about that. Why is it important to learn more about this and scrutinize this versus just looking at a deal?
Yeah, and again, I'll say it again, it's going to be of greater importance moving forward. We all know it could not stay as robust as it has. Right. And some are arguing, is there a recession coming, and what, how it's going to affect multifamily. I have my own theories and ideas and strategies. But nevertheless, I can tell you one thing: the underwriting process, the lending process is going to change. So the cost of capital is going to change, whether the economy and the strain of inflation has any kind of real effect, on multifamily. That's a conversation we can have at a later date. I'm just going to talk about interest rates and the cost of capital and the effect that has. And that is going to have an effect on underwriting, which is going to have an effect on operations. You're going to have to operate. No longer can you just buy a property, rehab it the way you want to rehab it, overspending rehab dollars with no payback periods in mind, raise the rents, 5, 10, 15, 20%, annually on every renewal. Those days are going to be, are somewhat over, are going to be over. If it's not over, it's going to stabilize. So you're going to have to, there's going to be a flight back to operations over the next 7 years. There's just going to be a flight back to operations, and where true operators in this industry are going to have to step forward, and you're going to see a lot of these guys who have bought highly leveraged to get those high returns and those aggressive IRRs. You're going to see a lot of those guys in trouble. You're going to see who's really swimming naked when this tide rolls back. So understanding even as a passive investor, these 5 phases are going to help you make the right type of decisions on who you want to go with when it comes to what team do you want to park your money with. The 5 phases are acquisitions, implementation, stabilization, growth, and exit strategy. Those are the 5 phases that navigate the multifamily investing industry. Acquisitions is all about acquiring the investment, from an income approach. It involves a CODA process, which I'll talk about, strategic evaluation of a target area. Your implementation is implementing the systems that are really important. There's two main systems: hard systems, soft systems. Hard systems are the procedures manuals. Soft systems are things like the property management. And then the third is your management plan. The systems, they operate the property. The systems tell the user how to actually perform, the task, and then the user, carries out those tasks, and that creates what we call, like a consistency. It creates almost like a franchise business model. So the systems identify the work that needs to be done and tell the user how to go about performing that work. And that gives you that consistency that you need day in and day out. Now, where the procedures and the operations manuals are generated from are the actual management plans. And we'll talk about that. So the management plan, dictates to the operations day to day to the property manager. Asset managers, the ones who oversee the management plan and the creating, which is basically the management plan is consists of the underwriting, the goals that are from the underwriting, the budgeting, and then from that you get the procedures manuals. The procedures manuals basically dictate the day-to-day operations, and then your reporting system. There's weekly, monthly, and annually reports that are reported back to the asset manager through these systems, so the asset manager can control and understand what's going on day to day. And those are, if you want to go back to that slide, I'll get to that. If you want to go back, and then that gets you into the next phase, which is stabilization. So looking at the reports and understanding and reading these reports on a weekly basis, you're able to make the proper adjustments. That's what stabilization is about. Anyone who tells you that a property is stabilized, a property is never stabilized. Never. You're always on a fault line. I don't care what type of property you're in, you're always one or two evictions, one or two non-renewals. It's always, a property being stabilized is almost a myth. It's a balancing act, and you're always, making adjustments. And any good operator who's ever operated understands that it's a constant balancing act. You can never take your hand off of the scale, or it goes like this. So that's why you're looking at those dashboard reports on a weekly basis that consist of your rent rolls, your delinquencies, your variance reports, your renewal reports, your traffic reports, all these things. And then you make adjustments. When you're reading these reports, you're able to see what's going on and keeping your finger on the pulse of that property. And you're able to make the proper changes that are necessary to the management plan. And then when you make the changes to the management plan, then from the management plan, the changes to the day-to-day operations are made through the operations manuals. So you're always constantly making those adjustments. And then that moves you into the next two phases, which are growth and exit strategy. So if you've done phases 1 and 2, acquisitions, implementation, and stabilization correctly, then growth and then the eventual exit strategy are natural occurrences.
Hey, thank you for breaking this all down. So would love for you to, maybe take a deeper dive into, once you build the multifamily model, this isn't what it ends up looking like.
So, yeah, it's very few people talk about it. Again, like I said, probably shocked a lot of people who thought we were just going to be going through deals. Any idiot can go through deals and spend an hour going through deals and saying, hey, this is what we're buying. This is what areas that we're looking at in the Sun Belt. Here's a nice particular property. It's $20 million. IRR is 14%, 18%. Cash flow is a 7, 8. That's all great, but how do you get there? What are the fun? How are you going to deliver? And more importantly, if something goes wrong, what's your SOP? What are the standard operating procedures that's going to guide you? I don't want to see pictures and glossy pictures of a property and you standing out in front of your property in front of a sign hollering about you just closed. That's I'm gonna give you $250,000 of my own money. I'm well past. I've been 20 years in this business. I'm well past understanding that taking glossy pictures and having really nice marketing packets that's not what this business is about. What are your operating procedures? How do you navigate? How do you operate day to day? If you have third-party management, how do you make the proper adjustments to the management team day to day? How are they reporting to you? You know, because ultimately that impacts my investment that I've given you. So that is what I want to know. This process kind of breaks it down. So if this is a model that everyone can kind of write down and jog down, but this is, or jot down, but this is really the industry. And this is like the path, the
This
way.
is what, if you're listening to other people talk about funds and things like that, and you're not seeing these types of things, good, you're not
Yeah,
again.
give you the map.
Yeah,
This is multifamily Zen.
right.
That's what this is. This is the way. This is the path. If there's no way, there's no path, you can't articulate. Because watch, fire some stuff at me if you want to. I'm going to show you how I make the adjustments within this path. So let's get started. So the model is what we just talked about. That's what we start with. Everybody needs to start with a model that addresses the 5 phases: acquisition, implementation, stabilization, growth, and exit strategy. You got to have a model that addresses. So when everybody, when Danny was watering plants, and I was spending hours amongst hours with Shane on the phone while he was playing basketball professionally in Japan, we were having conversations. Danny was watering plants. Shane thought he was having a conversation with me. Danny thought he was watering plants. I was looking at this model and I was putting people in place to help me run that model. That's what I was building. They think we were having conversations. They thought they were watering plants. I seen this model and staffing the right type of team and principles in place, you know, that would help me, you know, build this model. So once the model is done, you got your team in for acquisitions. You got your team that's going to help you in the implementation and stabilization, and you know, you got your team in place. Then you can move in what is known as the CODA process. That is how you then target areas. So people say, well, what are you investing in? I don't know. My CODA process has to tell me. Strategic evaluation of a target area. It's the study of building permit activities, average household income, average household size, demographics, psychographics. Demographics tells you who. Psychographics tells me, you know, why. So who my prospect tenant is and why they make decisions. And then mortgage interest rates. You know, all evaluating all of these aspects: building permit activity, average household size, unit mix. So, you know, the average household size tells me exactly what type of unit mix I'm looking for. So I'm studying this prospect tenant's demographics and psychographics, and I'm building out an avatar. That's what the CODA process does. It is a sole process to do one thing. And this, if you, all 28 that are on this call right now, if you take one thing home today, take this. Multifamily is not about buying buildings. It ain't never been about buying buildings. It's not about buying buildings. It's really about identifying a prospect tenant and then finding a particular asset that fits the needs of that prospect tenant. That's why that's how you know who really understands this business. Listen to these people out here talking. When they start talking buildings and they start talking bricks and mortar has never paid rent. People pay rent. It's the study and understanding how the interest rates and how inflation and all the things that we're facing, how it's going to affect your prospect tenants' demographics, how those adjustments are to be made, and how that's going to affect the asset class. So focusing on the individual first, then buying the building. You don't buy a building and then focus on the demographics. That's ass backwards. That's as wrong as 2 left shoes. You can't get any wronger than that. So you identify the prospect tenant, then you can look there, you can see, then we get into identifying what type of asset class, what type of building, what type of, you know, unit mix that fits that prospect tenant's demographic. Because there could be a building for sale that has the wrong unit mix. Average household size for a prospect tenant can be 4.7. The property for sale can be, you know, let's just say a bunch of studios and 1 bedrooms. That's the wrong asset class for that prospect tenant. When the average size is 4.7, or the average size, let's just say 3.2 family size, it's the wrong type of property. So you have to understand identifying the prospect tenant, then finding the subject property and backing them in, whether it be a, you know, and the prospect tenant will tell you what asset class, whether it be a B, C, you know, A asset class. The prospect tenant demographics, psychographics will identify that. That CODA process is going to help you identify that. Once you identify the subject property, then during the underwriting process, the management plan needs to be created. While you're underwriting, everyone talks about underwriting and jumps on spreadsheets and are spreadsheet jockeys. The spreadsheet is just a small fraction of what it's going to take. That damn spreadsheet can't operate my property day to day, Monday through Sunday. It doesn't collect rent. It doesn't handle renewals. It doesn't do the traffic reports. It's a small fraction. It's an important part, but it's just a part. With that underwriting, you have to be developing a management plan based on your CO, the information that you've gathered from the strategic evaluation of your target area. You start developing a management plan. The management plan basically breaks down the market. It breaks down the property, the physical property. It breaks down cost benefit analysis. It breaks down, when you're saying you want to do CapEx, it'll also have in there, okay, well, if you're going to renovate the units, you're going to put $2,000 into these units, what's the payback period? And if something should happen and you're not going to get a 5% bump, 10% bump in your rents, how are you going to, how is that going to affect the payback period? Because remember, IRR is a measure of efficiency. The IRR is a measure of efficiency. So when you bottleneck, if you say, well, I'm going to put $2,000 into a rental unit, right? And I'm going to get $1,600 in rents, and the payback period is going to be 30 days. Or I'm sorry, let's just say 6 months. But at the end of, the lease renewal, you're not able to increase the rents because you projected in your pro forma a 5% increase, but you weren't able to get that. Inflation and all the things that are happening, you are only able to raise the rents maybe 1%. What happens to your IRR? That IRR goes from 15%, 16% down to 12% immediately. That's why I'm saying that it's always, the stabilization is always a constant balancing act. You're always reverting back to that management plan. It's always that circle, that consistent circle, always stabilizing the property until the property is sold. And that's why it takes good operators, because you cannot take your hand off of that scale for a moment, because everybody's investing $1 into this product. Everybody who's put $1 in is banking on you to know what you're doing when shit hits the fan. Anybody can operate property in a market like we've had over the past 8 years. But we're not concerned about that. What happens when it goes wrong? What happens when it's 4th and inches? Can you make the type of play calls? That is what that is when we're talking about. That's character. That's the discipline to run and operate a property. That is where it's won and lost.
Right.
It's won and lost in the fine print. I'll say no more.
That's a great point. As you guys are scrutinizing investment opportunities, asking what happens if it goes wrong, because a lot of people are painting a rosy picture of what is possible, but what happens?
It will go wrong, Nathan.
Yeah.
Here's the thing: it will go wrong. You guys keep thinking multifamily. It's pulled the wool over a lot of folks' eyes, making it seem like it's such a simple investment. It's a great strategy, but it ain't as easy as how the market has been carrying it. It will go wrong. How are you going to operate when it goes wrong? How are you able to make? If you don't have a plan like what I just showed you, and this is a basic thing I put together so we all can kind of have a basic understanding. But brother, it's a constant game of adjustments. If you don't have a management plan, the foundation, and you don't have procedures manuals, and you don't understand what type of reports to look at to make these adjustments, then how can you navigate? How can you make proper adjustments? How can you forecast problems? Because it's not all about just making problems. Sometimes it's about just as important to avoid the iceberg than it is to run into it and make adjustments. Some of these problems you can avoid by adjusting course.
I was going to say, speaking of forecasting, I think we have Chad Musgrove on the call now, right? He just had a newborn baby yesterday, so he's joining us a little bit late, but I think he's on here now. Chad, you there?
Hey, I'm here, man. How's everyone doing tonight? And that wasn't yesterday, man. That was actually this morning, man, at about 7 a.m. So I apologize if I'm a little groggy. Got about 2 hours of sleep going here. So I will try to stay on task though, but I appreciate you having me.
Yeah, so this was just one slide I'll talk about quickly, and then we wanted to have Chad give us a little, he's deep in this industry and has been in this underwriting for a long time now. So he's going to talk about kind of what's to come on the horizon, but just a little bit about our fund. We're looking mainly for value adds. We're really pretty open to geography. I mean, we're local here in Tampa, Florida. So, we look a lot in Florida, but we're open to the whole Southeast. But yeah, our niche currently is the 20 to 80 units. And that's a little bit under the institutional class. So we're not going to be competing with those guys. So there's, Blackstone is not, we don't really want to compete against them. I mean, eventually, but right now we're looking at that kind of sweet spot where the mom and pops are maybe not running it quite as well. And we can come in and really add some value to the property and give investors the returns they want. But yeah, and for more details at the end of this, we're gonna be sending you links to the website that has an investor deck, and then also we'll give you some contact information to kind of get into the nitty gritty. But yeah, I know it's getting kind of late, so that's why I just wanted to have Chad just kind of give us his Nostradamus for 2022 and beyond.
Yeah, talk to us about what's going on at the underwriting table, Chad. What's blowing up? What deals are blowing up? What's the, give us the 911 or the 411 on what's going on in the market. But first, real quick, Chad, tell them who you are, what you do, what you've been doing, sir.
Yeah, absolutely. Well, first and foremost, thank you for having me. So Chad Musgrove, as was mentioned, for the better part of the last decade, about 11 years, multifamily finance is all I've done. Cut my teeth, cut my chops in New York, studied undergrad at Columbia U in the Ivy, and worked on Wall Street for a couple years, and then landed at a firm that I spent about 10 years at, essentially structuring multifamily deals all across the stack. So that was, small balance multifamily, conventional, market rate, affordable housing, senior, student, some assisted living, skilled nursing facilities, but manufactured, housing communities as well. And I'd say over the course of that career, probably structured a little over $2.5 billion worth of deals. And today, I sit in the seat. I'm here in South Florida as well. I can tell everybody I'm like LeBron, man. I took my talents down to South Beach and left New York for warmer weather and clearer sights on the seas. And so, I for the 11th largest bank in the country, I run the Miami office, structuring deals and working with some of the largest brokerage out there as well. We actually have a JV with Marcus and Millichap and other shops as well too. And sit here with Chavis Capital as well, working on structuring deals for us and working with capital partners as well. So with that being said, just kind of give a little commentary and background. I would say today, listen, much of what you've heard Brian talk about is absolutely spot on. All the things I'm sure you're hearing about, inflationary pressures, rising interest rates, et cetera. I would tell you, if you don't already, you should have a bookmark on your web browser, whether that's Google Chrome, Microsoft Edge, wherever you use. You can pick your poison, but I would recommend either the Wall Street Journal investor yield page, buy yield page, or just the Bloomberg yield page. And if you're going to be in this business, I would recommend that every day you literally just click on that bookmark and look at what the 10-year Treasury is doing. That's pretty much kind of the barometer that I would say 99% of institutional players follow, and all the things that you probably heard about, inverted yield curves, which just means that, on a longer return product, like a 30-year loan, you may be getting the same thing on a 10-year loan, or even a shorter, 2 or 3-year loan, you're getting the same thing on a 10-year loan. So the 10 year is kind of that barometer. I think today it was trading somewhere around, 2.98%. And just to give you an idea, I would say that, rates today, Fannie Mae and Freddie Mac, which are the type of loans that I mainly structure, are kind of the gold star in the industry. Just to give you an idea, you're talking about, $1 trillion marketplace here. Fannie and Freddie each every year get roughly about 78. Well, actually, the past year, they've had about 78 billion apiece of dry powder. So what that means is every loan that I structure, Fannie Mae or Freddie Mac will place a guarantee on that loan. So when Chavis Capital is going out to acquire an asset and we put a Fannie Mae or Freddie Mac non-recourse loan on that, we are getting essentially a guarantee, a stamp by Fannie Mae and Freddie Mac on a non-recourse loan, and then they're selling that to investors in the market. So today you're seeing interest rates anywhere from, I'd say, on the low end 4.3%, and what that low end means is that your leverage is probably somewhere around 55 to 60% leverage. On the high end, if you're getting 75, 80% leverage, you're probably anywhere from 475 to 5.25, depending on all the typical things that Brian mentioned, right? Where is the market? How's the property operated? What's going on in that marketplace? What do the demographics look like? Where are the strengths, et cetera, et cetera. So as interest rates rise, right, what's going to happen? That sponsor is going to be able to, is not going to be able to borrow as much money as they want. They're going to have to borrow less. So you're seeing a lot of these projects struggle. So, I would say, kind of to Brian's point, I mean, it's really going to be critical for you to do your homework and, focus on these markets. I'm in touch every day with our capital markets team. Like I said, we have a $25 billion servicing portfolio. I was talking to our pricing desk today, and they think there's about a 30% probability chance that we could see 100 basis point increase in the Fed funds rate, right? And 30%, albeit maybe a little bit low. And Brian, I see you shaking your head, but guess what? They think there's about an 80% chance that we'll get another 75 basis point increase. So what does that do to all of the models and all of the deals that, everyone on this call is looking at? Guess what? Your cost of capital, your borrowing cost is going to be, it's going to be more expensive. So guess what? That's going to be less money that you borrow. That's going to be more equity that you got to put into a project. There's going to be more equity that you raise. That's going to be, more cost that you're paying back to your investors, right? The other one that I would tell you to watch when I mentioned that, that Bloomberg page and that Wall Street Journal page, the big index that a lot of people used to watch, right, was the 30-day LIBOR. LIBOR effectively has kind of gone away within the institutional, real estate world, right? The 30-day SOFR is pretty much the barometer now, kind of in the bridge and short-term lending space. And for those of you who don't know, SOFR stands for the standard overnight fixed rate, right? So you have a 30-day SOFR and then you have a daily SOFR rate. The 30-day is probably somewhere around 1.4% today. I think the daily SOFR is just slightly higher because of the risk of trading it every day at like 1.5%. So, when you're going out to quote business, right, on what we call short-term or bridge lending, I can tell you, here we're underwriting deals every day. And for you to get a permanent fixed loan, you have to just know that your leverage is going to be 55 or 60%. I mean, that's just the way the math simply works when a deal is trading at a 4% cap rate, right? In a market like Tampa, and in some instances at, 3.5%. So you have to know that you're going to have to come up with a very sizable equity check on a permanent loan basis. Whereas if you can, use Brian's process, you can identify a good property where there is a value add component. Bridge financing is the alternative that everyone is looking at, right? And so I would say, bridge financing average pricing today is probably somewhere between, the stronger banks like ours will, require a little bit of recourse, but you can get a spread of 250 basis points over that SOFR, right? Which is like 150, right? So you're 4% all in on a bridge rate. And, what you need to know is that with that product, though, you have to buy an interest rate cap. Well, guess what's happened when there's a lot of volatility in the marketplace, right? And look, all that volatility means is that, interest rates are here, they're down here, they're up here, they're over here, they're to the left, to the right, they're, it's like you're doing the hokey pokey and it's all around. So, when that happens and you have to buy the interest rate cap, guess what? For somebody who says, hey, Daniel, I am going to make sure that your interest rate does not go above, call it say 5.25, because rates are, 4.5%, 4% today. So I'm gonna give you 150 basis point swing because I got to make a little money for taking the risk, but I'll provide you with an interest rate cap. Well, guess what, folks? Those caps that you were buying on those loans, if you'd have called me, I'd say 90 days ago plus for a, call it say, $6, $7, $8 million loan, that cap might have been 40 grand. Guess how much that cap is today? I had a deal trade that was a $8 million loan, and that interest rate cap traded at over $200,000. Right. So you look at that swing in 90 days. So, it's a very volatile marketplace. But you want to make sure that you're, sound in your underwriting. You want to make sure that, you're sound in your investment thesis. You want to make sure that you're taking the time to understand, the value add proposition, like Brian mentioned, and identifying these, properties in these marketplaces. Because I will tell you that, cap rates kind of nationwide are, I'd say 5% at best in what we call, your secondary, tertiary markets, right? I got a client who is looking at $105 million purchase for almost, or actually, I think it's over 500 units in Jackson, Mississippi, right? They specifically reached out to me because I grew up in Mississippi, on the coast of Mississippi. So I will tell you that, they're taking a deeper dive into various markets where, there is growth because quite frankly, we've underbuilt housing for so long. We're probably short 7 million units of affordable housing across this country. So, I mean, listen, multifamily has been tried and true. It's been proven. I mean, it was able to, obviously withstand, everything that happened with COVID. And at the end of the day, as an inflation hedge where everyone sees it, right? Lease terms are somewhat of short term, right? It's, to put it into, another way of thinking about it, think about like if you go to the bank and you buy a 6-month CD or you buy a 1-year CD, right? Those rents are locked for a year. But, for people who've been investing in, say, I bonds, right, where inflation's been going up, you're going to be able to reset over that 6 months of that year and drive those rents. And in some instances, it may even be less than that, right? Where in markets where rents, I mean, look, Tampa, right, where rents in some cases, man, they double, they're up 50 to 100%, right? You can just go in and buy a tenant out because they know it's coming. Right. So it comes down to, investors, what's your business plan? Right? Would you like to operate a property? You want to operate it below market just to stay, leased up and rented? or are you trying to maximize, your profit, that efficiency that Brian is talking about, and generate your return as quick as possible for your investors, and then look to have a capital event? But guess what? What I will say to you, in this voluntary, volatile marketplace that we have today, you better know how to operate, because it's not about just looking at what the next guy has done with his rents, and you haven't gone in to look at what's his unit mix, like Brian said. What's the level of finishes that he has at his property? How big are his units compared to yours? Where are the demographics changing in the marketplace, right? Is growth coming to you, or is it going away from you, into a different area, right? So you better know how to churn and handle those rents, because that's what's going to allow you to navigate, a volatile marketplace. So, yeah, I mean, I know that was a lot. I'm happy to go back over any
I feel
other
like there was
points, but
a little bit of doom and gloom in there with that. You ended on some hope though.
yeah. No, man, look, I,
Um,
I would say this. I don't want it to be doom and gloom, Danny. What I want people to realize is that, you just have to be, you have to take a very fine-tooth comb to what you're doing today. I think listen, I think you can buy in any point in the cycle, right? What you got to remember in the cycle is that at the top where we're at, you got construction, right? You got new product. Then you go from there to, potentially to distress, where people don't perform, where budgets are being busted, like what Brian talked about, where rents are driving up. And not necessarily that somebody's going to go underwater, but they just may need to recapitalize a deal, right? And take one investor out and put another one in that just has a different return profile. Maybe they had a guy who only wanted a 3-year return. Now they found an investor who's fine with a 7-year return, right? Then you kind of go around to the value add, space again, and then you go to the heavy value add, and you get back to construction. So you can certainly buy and find deals, in any marketplace. Look, I had a client that just called me the other day that found, in again, even just use it in the Panhandle of Florida. Guy out of Mobile, he found a 50-unit foreclosure deal, where it was a USDA loan, and he was able to pick it up for, something ridiculous like $15,000 a door. But it's a complete gut and reno, and it's probably, 25,000-30,000 a unit that he's going to have to put into it. And guess what? That's not going to appraise. No bank is going to do that. So he's got to either go hard money or come out of pocket to do that. But guess what? When he turns that property around, it's probably going to be worth 80, 90 to 100 and some thousand a unit. So he's got a big profit and payday coming. So you can always operate and find deals in any market, any marketplace, any cycle. But it comes down to having a good operator. That's it, man.
I prefer the doom and gloom, because that's where the money is. That's where it's won. So give me the doom and gloom. This rosy picture has brought everybody and their mother to the table. So I'll take a little doom and gloom to keep the faint at heart away. Let the skillful operators play in that realm. So thanks, Chad. I appreciate that.
I add one
insight.
piece to that, right? I'm seeing in my world, I'm seeing a lot of institutional investors that are coming back in and saying, okay, right, they're syndicators who were not experienced and didn't have a good operator, who are literally just bidding deals up and trying to buy something in 2018, not do anything to it, and flip it in 2020, right, and just ride the market up. They're seeing where those folks don't have the same purchasing power they had before then. And I think that's more so what I want to allude to, not that, the sky is falling, because it's not. Like I said, I mean, look, you turn on the local news every day and all you hear about is, some person who can't afford to be in their place. I mean, listen, a part of it is, listen, a lot of my business that I do is affordable housing, and I have a passion for that as well, too. And there's a part of it. But at the end of the day, like I tell people, markets are going to evolve and change. That's just the simple fact of it. I think that, local officials can, figure out ways to provide opportunities for people to stay in markets. But at the same time, I mean, listen, I lived in Mississippi at one point in my life. I also lived in New York, and now I choose to live in Florida where, I can be 20, 30 minutes from the beach, right? And I'm going to pay for that life experience. So, I shouldn't be, I shouldn't be penalized because I'm willing to pay for that life experience. And someone, hasn't either been afforded or made the opportunity to do that. So, listen, put it like this, I'm a registered independent, man. And, I am a capitalist too. But I mean, listen, you can do good and make money too. I'll say that.
Love it. Hey, real quick, I just want to say thank you guys for joining us this Wednesday evening. Chad, thank you for your expertise. Dr. Danny, Brian, as you guys are looking to invest, we hope that you guys will schedule a call with Dr. Danny or another member of our team. Clearly see we're stacked with full of experts. If you guys have questions, you guys can always call and speak to one of our team members. We would love to help you guys, learn multifamily investing, whether you're looking to do it yourself or you want to join the Chavis Capital team. Danny, would love to just close it out, man.
Sure. So I guess I don't know if we said this right in the beginning, but we are a 506c, so we're open to accredited investors only. So I think most of you on this call are accredited. If you need to look up the definition, you can, but it means you have a net worth more than $1 million, or you make more than 200,000 as an individual, or 300,000 as a couple. But so our fund is just for accredited investors. I'm sure you have a lot of questions about specifics. What's my return? What's the minimum? How am I gonna get my money back? And we have on our website, there is a slide deck that you can download. There's also, as Nate's kind of showing you here, if you go to chaviscapitalre.com and you sign up to be an investor, you'll get put on our newsletter. And so this will kind of automatically get you in our system. But yeah, click around on the website. There's a download the investor deck. And then, ultimately you're going to have more questions, and you're not going to write a check until you talk to somebody and have a one-on-one conversation and get all your questions answered. And so you can do that with me. This is all my contact information right here. If you use Calendly, that's one way to do it. Obviously you can also text me as well. But yeah, I'm happy to talk to you guys. Probably not tonight since it's getting late. And my wife is putting our 2 boys down, but I'm happy to talk to whoever's interested. And thank you for your time. We appreciate it.
All right.
Thank you.
You guys have a wonderful evening, and thank you so much for joining us.
Thank you, guys. I appreciate everybody's time. Thank you for spending time with us this evening, everyone. Hopefully you learned a little something, and I look forward to having some conversations with you as well. So feel free to reach out to me. Take care, guys, and be blessed, everyone.